Imagine walking out to your mailbox on a quiet afternoon, expecting the usual stack of grocery flyers, utility bills, maybe a letter from a grandchild or a bank statement. Nothing unusual, nothing urgent. But buried in that pile is an official envelope with a return address that instantly tightens your chest: the Internal Revenue Service. At first, you assume it must be routine, maybe a small correction, maybe a request for clarification. But when you open it and begin reading, the words on the page don't make sense. According to the notice, you owe a penalty, not a small one either: $10,000. And the most confusing part of all is that you have absolutely no idea what you did wrong. You didn't hide money overseas. You didn't run a secret business. You didn't cheat on your taxes. You simply deposited your own money into your bank account. Maybe it was cash from selling an old pickup truck. Maybe it was money your daughter gave you to help with medical bills. Maybe it was savings you'd kept at home for years and finally decided to put back in the bank. Completely normal things, the kind of everyday financial decisions retirees make all the time. And yet somehow those normal actions triggered a penalty that can start at $10,000. What's happening here is something that's catching many retirees completely by surprise. Because the problem usually isn't illegal money, it isn't tax fraud, and it isn't anything dramatic like the things you hear about on the news. The real issue is something far more subtle. It's a pattern of deposits or transactions that automated systems interpret in a very specific way. Systems that don't know your story, don't understand your intentions, and don't see the human side of the transaction. They simply see numbers moving through accounts. And when those numbers form the wrong pattern, alerts can start appearing quietly in the background of the financial system. The result can be questions, investigations, and in some cases, penalties that feel completely unfair to the people caught in the middle of them. What makes this even more unsettling is that the rule behind all of this has technically existed for decades. It isn't brand new legislation. It isn't some sudden policy change that just appeared overnight. The difference today is how aggressively and how efficiently the system is able to detect certain types of activity. Banking reports that once sat quietly in government databases are now being analyzed instantly by powerful automated systems that cross-reference financial data in ways that simply didn't exist years ago. In other words, the financial world has changed, and many retirees are still operating under assumptions that made sense 20 or 30 years ago, but can create real problems today. That's why understanding this one specific banking behavior has become so important. Because when you know what the system is looking for, avoiding trouble becomes surprisingly simple. But if you don't know how the rules work, an innocent trip to the bank can accidentally create a very expensive misunderstanding. Hi, I'm Sophia, and I spend a lot of my time helping retirees protect the savings and financial security they spent decades working to build. Retirement is supposed to be the stage of life where your finances finally feel stable, predictable, and under control. But in the last few years, the financial landscape has quietly shifted in ways many people haven't fully noticed yet, especially when it comes to how banks report certain transactions and how those reports are analyzed by government systems. My goal today isn't to alarm you or make routine banking feel stressful, quite the opposite. I want to give you clarity because once you understand exactly what triggers these issues, you'll realize that protecting yourself is mostly about awareness and a few simple habits. In this video, we're going to break down exactly what kind of everyday bank activity can trigger serious attention from the IRS, why retirees are often the ones who get caught unaware by this rule, and the single mistake that turns an otherwise harmless deposit into something the government treats very differently. We'll also talk about why enforcement in 2026 feels so different compared to the past, even though the rule itself has technically been around for years. And most importantly, I'll show you how to make sure your own banking activity stays completely safe and straightforward so you never find yourself opening that kind of alarming letter in the mail. Because once you see how this system actually works, something surprising becomes clear. The action many people take in order to avoid attention from the government is often the exact thing that creates attention in the first place. And understanding why that happens is the key to protecting yourself moving forward. To understand how these problems begin, let's start with something that looks completely harmless on the surface. Picture a few situations that are very common in retirement. Maybe you sell your old pickup truck for $15,000 in cash. The buyer shows up, counts out the money, and the next day you walk into your bank to deposit it. Or maybe your son wires you $20,000 to help cover unexpected medical expenses. Perhaps you've been holding on to cash savings at home for years and finally decide it's time to move that money back into the bank. Some retirees receive a lump sum pension payout. Others sell a boat, an RV, or a piece of personal property they no longer need. Sometimes money simply moves between accounts because you're preparing for a major purchase or helping family. None of these situations are unusual. In fact, they're exactly the kind of financial decisions people make every day during retirement. From your perspective, these actions are perfectly normal because they are. It's your money. You earned it, saved it, or received it through legitimate means. Depositing it into your bank account should be one of the most routine things you can do, and in most cases it still is. But what many retirees don't realize is that banks today operate in a financial reporting environment that's far more automated and interconnected than it used to be. Banks are no longer just places where money sits safely in an account. They're also required to act as reporting institutions when certain types of financial activity occur. This reporting isn't about accusing customers of wrongdoing. It's about documenting activity that meets specific thresholds set by federal law. Every day, thousands of transactions across the country are quietly recorded and transmitted through secure reporting systems designed to monitor large movements of cash. Most customers never even notice it happening because the process takes place entirely behind the scenes. You walk in, deposit your money, get a receipt, and go about your day. But the bank systems may automatically generate reports that are sent to government databases where they become part of a much larger financial picture. When those reports arrive in government systems, they don't just sit in a digital filing cabinet anymore. Modern financial oversight relies heavily on automated analysis. Sophisticated programs sort through enormous amounts of data, looking for inconsistencies, unusual patterns, or activity that doesn't appear to match other financial records. These systems compare information from multiple sources: tax returns, banking reports, retirement distributions, Social Security payments, and other financial data streams. Their goal isn't to judge intent. They simply analyze numbers and patterns. And when those patterns don't line up with the information the system expects to see, it raises questions. From the perspective of a retiree managing everyday finances, that can feel frustrating because the system doesn't understand context. It doesn't know you sold a truck last week. It doesn't know your daughter gave you money to help with medical expenses. It doesn't know you've been saving cash in a safe at home for the last 10 years. All it sees is that a certain amount of money suddenly appeared in your account. And when that amount crosses certain thresholds, the system begins asking one very simple question. Where did this money come from? And does the financial data we already have about this person explain it clearly? To understand why that question matters so much, we need to talk about a rule that has existed in the United States for decades. A rule that most people have heard about in passing, but very few fully understand. It's called a currency transaction report, often shortened to CTR. The name itself sounds complicated, but the concept is actually very straightforward. Federal law requires banks to file a currency transaction report whenever a customer conducts a cash transaction over $10,000. That includes cash deposits, cash withdrawals, and sometimes other types of cash-based transfers. If someone walks into a bank and deposits $12,000 in cash, the bank is required to document that transaction and submit a report through the appropriate financial monitoring channels. Now, here's the key point that surprises many retirees when they first learn about this rule. A currency transaction report is not a penalty. It's not an accusation of wrongdoing. It doesn't mean the IRS believes a crime occurred. It is simply a reporting requirement designed to create transparency around large cash transactions. Millions of these reports are filed every single year in the United States. Businesses deposit daily cash receipts. Individuals deposit proceeds from selling vehicles, equipment, or other personal property. Families move large amounts of cash during major life events. The bank files the required report. The transaction is recorded. and for the vast majority of people, nothing further ever happens. For many years, this reporting system functioned quietly in the background of the financial world. Banks submitted reports when required, and unless something clearly suspicious appeared, those reports rarely received additional scrutiny. They served primarily as records that investigators could access if a larger financial investigation was already underway. In other words, the system existed, but most everyday banking activity simply passed through it without much attention. What has changed in recent years, however, is how these reports are processed and analyzed. Instead of sitting passively in databases waiting for human investigators to review them, they now feed directly into automated systems that examine financial patterns almost instantly. These systems compare reported cash transactions against other financial information connected to the same individual. They look at timing, frequency, and consistency. If a large cash deposit appears, but there's no obvious explanation within the surrounding financial data, the system may flag the transaction for further review. And this is where things begin to shift from routine reporting into something that can create confusion for retirees because the real issue isn't the report itself. In fact, filing a currency transaction report is often the safest and most normal outcome for a large cash deposit. The real problems usually begin when people try to avoid triggering that report without realizing that doing so creates a very specific pattern that the system is designed to detect. Now, this is where the story takes an unexpected turn, and it's also the point where many well-intentioned retirees accidentally create problems without realizing it. Because once people learn about that $10,000 reporting threshold, a very natural thought pops into their minds. The thought sounds something like this. If depositing more than $10,000 causes the bank to file a report, maybe it's better to keep deposits under that number. On the surface, that logic feels perfectly reasonable. Many people assume avoiding extra paperwork or government reporting is simply a way to keep things simple and private. But in the world of banking regulations, that instinct can actually backfire in a very serious way. Let's walk through a simple example so you can see exactly how this happens. Imagine you have $12,000 in cash. Maybe you sold a boat. Maybe you've been holding on to emergency savings at home for years and finally decide to put it in the bank. Maybe it's money you received from a family member to help with a major expense. Whatever the source, the money itself is completely legitimate. As you walk into the bank, you remember hearing somewhere that deposits over $10,000 get reported. So instead of depositing the entire amount at once, you decide to split it up. You deposit $8,000 today. Then a couple of days later, you come back and deposit the remaining $4,000. From your perspective, nothing about that decision feels dishonest. You're not hiding income, you're not avoiding taxes, you're simply trying to avoid unnecessary attention. But in the eyes of federal law, that small decision can change the situation dramatically. Breaking up a large cash transaction into smaller pieces, specifically to avoid triggering the $10,000 reporting requirement, is known as structuring. Structuring occurs when someone intentionally divides deposits or withdrawals into smaller amounts so that each individual transaction falls below the threshold that would normally require a currency transaction report. The important detail here is that the legality of the money itself doesn't determine whether structuring has occurred. Even if every dollar came from a completely lawful source, intentionally splitting the transaction to avoid the reporting requirement can still be considered a violation of federal regulations. That's the part that surprises people the most. Many retirees assume the law is focused on the money itself, whether it came from something illegal or unreported. But when it comes to structuring, the focus is actually on the pattern of the transactions. Regulators designed these rules decades ago as part of efforts to combat money laundering and organized crime. Criminal organizations would often attempt to move large amounts of cash by breaking deposits into smaller pieces to avoid triggering mandatory bank reports. To prevent that tactic, the law specifically prohibits structuring transactions for the purpose of avoiding those reports. Over time, banks developed systems to detect these patterns automatically, and those systems have become extremely sophisticated. Modern financial monitoring systems don't just look at individual deposits in isolation. They analyze sequences of activity across days, weeks, and even months. They examine how often deposits occur, how close they are to reporting thresholds, and whether the timing suggests a deliberate attempt to remain under that limit. When multiple deposits appear that together exceed $10,000 but are separated into smaller amounts, the system may identify that pattern as potential structuring. Once that happens, the situation can escalate quickly. Financial institutions are required to document suspicious activity and submit additional reports that may trigger deeper reviews. This is where the potential for serious penalties comes into play. Violations related to structuring can carry substantial financial consequences. In some cases, penalties can start around $10,000 and increase, depending on the circumstances and number of violations involved. Even when the money itself is completely legitimate, proving that a pattern of deposits was not intentionally structured can become complicated and stressful. Investigations take time, documentation may be required, and the process can create enormous frustration for people who believe they were simply managing their money responsibly. The irony is that the action many people take to avoid attention is often the exact action that attracts attention. Depositing $12,000 in one straightforward transaction usually results in a simple currency transaction report being filed by the bank. That report goes into the system as routine documentation, and in most cases, nothing else ever happens. But splitting the same amount into smaller deposits can produce a pattern that automated systems are designed to examine much more closely. The system doesn't know your intentions. It doesn't hear your reasoning. It only sees the sequence of numbers moving through the account. And when that sequence resembles a pattern associated with structuring, the system responds accordingly. This is why understanding the difference between normal reporting and structuring is so important. A currency transaction report is simply part of the standard financial reporting process. It's routine. It happens millions of times every year. Structuring, on the other hand, is specifically defined as attempting to avoid that reporting requirement through the way transactions are arranged. The safest approach is often the simplest one. If you have more than $10,000 in legitimate cash to deposit it in a single transaction and allow the bank to complete the reporting process as required. If this explanation is already helping clear up some confusion about how these banking rules work, take a quick moment to like the video and subscribe to the channel. My goal here is to help retirees understand the financial rules that affect their savings so they can avoid costly mistakes before they happen. Because now that we've covered the biggest misunderstandings surrounding cash deposits, the next step is even more important: understanding how to protect yourself moving forward so your banking activity stays simple, clear, and completely worry-free in today's automated financial environment. At this point, many retirees hearing this explanation for the first time have the same reaction. They think, wait a minute, I thought breaking up deposits was the safer option. And that reaction makes perfect sense because for decades, a lot of people believed that keeping transactions small was simply a way to avoid unnecessary attention from financial institutions. That belief didn't come from bad intentions. It came from a misunderstanding about how the reporting system actually works. For many years, people imagined the $10,000 threshold as some kind of warning line. They thought crossing that line would automatically trigger suspicion audits or investigations. So naturally, they tried to stay below it. But the truth is almost the exact opposite. The reporting requirement itself is not suspicious at all. It's simply part of the banking system standard procedure. Banks are required to report large cash transactions, so there is a record of them. Once that record exists, the system has documentation explaining the movement of funds. In most cases, that's the end of the story. The real concern begins when patterns appear that look like someone is deliberately trying to avoid that reporting process. And that's where retirees often get caught by surprise. Many people splitting deposits are doing it for completely innocent reasons. They're not thinking about federal banking laws. They're simply thinking about convenience or privacy. But automated monitoring systems don't evaluate personal motives. They evaluate patterns. To understand how powerful these systems have become, imagine looking at your bank account activity through the eyes of a computer that processes millions of transactions every single day. The system doesn't see a retiree who just sold a fishing boat. It doesn't see a grandparent helping a grandchild with college expenses. Instead, it sees a timeline of deposits: $8,000 on Monday, $4,000 on Wednesday, maybe another small deposit the following week. When the system compares those numbers and notices they cluster just under the reporting threshold, it recognizes a pattern it has been trained to detect. These programs analyze far more than just the dollar amount of a single deposit. They look at the spacing between transactions. They examine how often deposits occur within certain time windows. They evaluate whether the sequence resembles activity that regulators historically associated with attempts to avoid reporting requirements. And because these systems process enormous amounts of financial data, they can identify patterns that would be very difficult for a human investigator to notice manually. This is one of the biggest shifts in the financial environment retirees are dealing with today. Years ago, much of this oversight relied on human review. Reports existed, but someone usually had to take the time to examine them individually before any action happened. Today, advanced data analysis systems can connect financial dots almost instantly. They cross-reference bank activity with other financial information, including tax filings, retirement income records, and even historical transaction behavior. If the numbers align consistently, the system moves on. But when something looks inconsistent or deliberately structured, alerts can be generated automatically. That's why the most important concept to understand in today's financial world is something very simple: clarity. When your financial activity tells a clear and consistent story, automated systems typically have no reason to raise questions. But when deposits appear in ways that resemble attempts to avoid reporting rules, the system notices, not because it assumes guilt, but because its programming is designed to identify those exact patterns. So, what does this mean for retirees managing their day-to-day finances? The first and most important takeaway is this: the $10,000 reporting threshold is not something you need to fear. Depositing more than $10,000 in cash is not illegal. It doesn't automatically trigger an investigation. It simply means the bank files a routine report documenting the transaction. In fact, allowing that report to be filed is usually the safest way to ensure your financial activity is recorded clearly and transparently. This is where the mindset shift becomes important. For many years, people believed the safest approach was staying under the radar. But in today's automated system, attempting to stay under the radar can actually create the radar signal. A single deposit of $12,000 is a straightforward event. The bank records it, files the report, and the transaction becomes part of your documented financial history. But multiple deposits intentionally arranged to stay under the threshold can create a pattern that invites far more scrutiny. If you're finding this information helpful so far, take a moment to make sure you're subscribed to the channel. I regularly share updates and explanations like this designed specifically for retirees who want to stay ahead of financial rules that could affect their savings. A simple misunderstanding about how banking regulations work can sometimes lead to expensive consequences, and the goal here is to make sure that never happens to you. Now that we've cleared up the biggest misconception about cash deposits and reporting thresholds, the next question becomes even more important. How can you protect yourself moving forward? What simple habits can make sure that even in a world of automated financial monitoring, your transactions always tell a clear and accurate story? That's exactly what we're going to break down next. Because the good news is that protecting yourself is far easier than most people think. Now that you understand where the real risk comes from, the next step is focusing on protection. Because the goal here isn't to make banking feel complicated or stressful. In fact, once you understand how the system works, protecting yourself usually comes down to a few simple habits that create clarity in your financial records. Think of it this way: automated systems rely entirely on data. They don't hear explanations. They don't see context unless that context exists somewhere in your financial documentation. So, the key to staying safe is making sure that when money moves through your accounts, there is a clear and consistent story behind those numbers. The first habit that protects retirees more than anything else is documentation. Whenever a large amount of money moves into your account, you want to have some form of record explaining where it came from. That doesn't mean complicated legal paperwork. In many cases, something very simple is enough. If you sell a car, keep a bill of sale showing the amount and the date of the transaction. If you sell a boat, a motorcycle, or an RV, keep the written agreement or receipt that confirms the sale. If a family member gives you money to help with expenses, it can be helpful to keep a short gift letter stating that the funds were given as a gift and not as income or a loan. These kinds of documents create a paper trail that explains the movement of funds if questions ever arise. Many retirees already keep records like this without realizing how valuable they are. Receipts, invoices, transaction confirmations, and account statements all contribute to the story your finances tell. When everything is organized, it becomes very easy to explain where a deposit came from if anyone ever asks. And in most situations, having that documentation ready makes potential issues disappear quickly because the financial activity aligns perfectly with the record supporting it. The second habit that provides strong protection is making sure your tax reporting reflects your real financial activity. This doesn't mean you need to worry about every small deposit or transfer, but when large transactions occur, especially ones connected to sales of property or significant financial events, it's helpful to make sure your tax return tells the same story as your bank records. This is where a qualified tax professional can make a huge difference. A good CPA or tax advisor doesn't just fill out forms once a year. They help make sure the financial picture presented on your tax return matches the real events happening in your life. For example, if you sell a piece of property or receive a large distribution from a retirement account, those events often have tax reporting requirements. When those reports match what appears in your banking activity, the system sees consistency. Consistency is what automated analysis systems expect to find. When numbers align across different financial records, there is rarely any reason for additional scrutiny. The third protective habit is something that surprises many people because it goes against what older financial advice sometimes suggested. That habit is simple transparency with your bank. If you're depositing a large amount of legitimate cash, there is no benefit to trying to make the transaction appear smaller than it is. Allow the bank to process the deposit normally and file any required reports. Remember, those reports are routine. Banks submit them every day for customers across the country. Trying to avoid them is what creates unusual patterns. When you combine these three habits, clear documentation, consistent tax reporting, and straightforward banking activity, you create a financial record that makes perfect sense when viewed through automated systems. Your transactions form a timeline that is easy to understand because each major event has supporting context behind it. That clarity acts as a kind of protection layer around your finances. This leads to something important that many retirees don't hear explained clearly enough. The IRS and banking regulators are not sitting around trying to penalize people who deposit their own money. The vast majority of financial reporting systems are designed simply to identify patterns that historically indicated illegal activity, such as money laundering or hidden income streams. When someone's financial behavior fits normal patterns and is supported by documentation, the system generally moves on without any issue. What causes problems is not usually the size of a transaction. It's the confusion created when the data surrounding that transaction doesn't line up clearly. A large deposit with an obvious explanation is rarely a problem, but multiple smaller deposits that appear intentionally arranged to avoid reporting can create a very different interpretation in automated monitoring systems. So the real goal isn't secrecy. The real goal is clarity. When your financial activity is clear, documented, and consistent across your banking records and tax filings, automated systems have little reason to question it. That clarity becomes one of the most powerful forms of financial protection available in today's digital banking environment. And once you understand that principle, the entire situation starts to make much more sense. The financial system isn't looking for ordinary retirees managing their money responsibly. It's looking for patterns that don't add up. When your financial story is easy to follow on paper, you're operating exactly the way the system expects. At this point, it helps to step back and look at the bigger mindset shift happening in the financial world because a lot of the confusion surrounding these rules comes from habits that made sense decades ago but don't work the same way today. For many years, people believed the safest approach to financial privacy was simply to keep things quiet, avoid drawing attention, keep transactions small, handle things in a way that didn't trigger paperwork or reporting requirements. That mindset developed during a time when most financial oversight depended heavily on manual review. Bank reports were filed, but unless someone had a specific reason to examine them, they often remained untouched. Today, the environment is very different. The modern financial system is built around data analysis. Transactions flow through networks that compare information across multiple institutions and databases. Instead of waiting for a human investigator to notice something unusual, automated systems constantly scan financial activity, looking for patterns that match predefined criteria. And those systems are extremely good at recognizing when numbers appear to be arranged in ways that avoid reporting thresholds. This is where the irony of the situation becomes clear. The strategy many people once believed kept them under the radar is now exactly what creates the radar signal. One large deposit of $15,000 with a clear source and proper documentation is usually processed, reported, and forgotten. But multiple smaller deposits that appear carefully arranged just under reporting limits stand out because the system is designed to identify that exact behavior. Think about it like this. If you look at a financial timeline from the outside, a single large event often makes perfect sense. Someone sells a vehicle, deposits the proceeds, and the transaction appears as one clean entry in the account history. But when deposits start appearing in clusters that conveniently avoid reporting thresholds, the timeline begins to look unusual from a data perspective. Again, the system isn't reading your intentions. It's simply comparing patterns against models that were built to identify certain types of activity. This shift toward automated oversight is one of the most important financial developments retirees need to understand. Banking regulations themselves haven't dramatically changed in recent years. The rule requiring currency transaction reports for transactions over $10,000 has existed for decades. What has changed is the speed and precision with which financial data can now be analyzed. Transactions that once blended quietly into the background of the banking system are now part of a much larger digital picture. But here's the reassuring part of that story. When your financial activity follows straightforward patterns and is supported by clear documentation, these automated systems usually have nothing to question. In fact, the system is designed to move past transactions that appear normal and consistent. That's why adopting a mindset focused on transparency and organization is so powerful. Instead of worrying about how to avoid attention, the smarter approach today is making sure your financial records tell a clear story. If you found this explanation helpful so far, this is a great moment to take a quick second and subscribe to the channel. I share guidance like this specifically for retirees who want to protect the savings they worked decades to build. Financial rules and reporting systems continue to evolve, and understanding those changes before they affect you is one of the best ways to avoid unnecessary stress or expensive surprises later on. Now that we've covered the mindset shift and why the system works the way it does, let's zoom out even further and talk about the broader financial environment retirees are navigating today. Because the changes we're seeing in banking oversight are part of a much larger transformation that's reshaping how financial institutions and government agencies interact with data. And understanding that bigger picture can help you make smarter decisions about how you manage your money going forward. To really understand why these rules feel more visible today than they did years ago, it helps to look at the bigger transformation happening across the financial system. Banking, taxes, retirement accounts, investment platforms, and even payment apps now operate in an environment where information moves quickly and digitally. Institutions that once operated largely in separate systems are now connected through reporting frameworks designed to increase transparency and reduce financial crime. That doesn't mean every transaction is being scrutinized or that someone is watching individual bank accounts in real time. The reality is much more mechanical than that. Financial data simply flows through automated processes that compare numbers against other numbers. Banks submit reports when certain thresholds are met. Tax returns provide another set of financial data. Retirement distributions, Social Security income, brokerage activity, and other financial records create additional pieces of the puzzle. Modern analysis systems assemble those pieces to make sure the overall picture makes sense. For retirees, the important takeaway is that consistency across these pieces of information is what keeps everything running smoothly. When deposits, income, and financial records align naturally, the system recognizes that pattern as normal. But when numbers appear disconnected from each other, that's when additional questions sometimes appear. Again, it's not about assuming wrongdoing, it's about resolving inconsistencies in the data. This is why organization has quietly become one of the most valuable financial habits retirees can develop. Keeping documents related to major financial events like selling property, receiving gifts, taking large distributions, or depositing significant amounts of cash creates a clear explanation for those transactions if it's ever needed. And in today's digital world, organizing records is easier than it used to be. Many people simply scan important documents and store them securely on a computer or cloud storage service along with their tax records. That way, if a question ever arises months or even years later, the documentation is easy to retrieve. Another helpful step is periodically reviewing your own financial activity the way an outside system might see it. Imagine looking back at the past 12 months of your bank statements and asking a simple question. Would someone reviewing this data understand where major deposits came from? If you sold a vehicle, does the deposit roughly match the timing of that sale? If you received money from family, do you have some written acknowledgement explaining it was a gift? If you withdrew or deposited a large amount of cash, would you be able to explain the purpose of that transaction without scrambling to reconstruct the details? Doing this kind of self-check once in a while can provide a surprising amount of peace of mind. It allows you to identify any gaps in your documentation while the details are still fresh in your memory. Maybe it means adding a simple note to your records explaining a transaction. Maybe it means scanning a receipt or bill of sale so it's saved alongside your tax documents. These small steps take only a few minutes, but they create clarity that can prevent confusion years down the road. It's also worth remembering that most retirees go through their entire retirement without ever encountering a penalty related to structuring or reporting rules. The system processes millions of financial transactions every day, and the overwhelming majority of them are routine. When deposits are handled straightforwardly and the surrounding financial information makes sense, they simply become part of the normal flow of financial activity. The situations that create stress almost always come from misunderstandings. People trying to follow what they believed were smart financial habits based on outdated advice. They thought they were avoiding attention by splitting deposits, when in reality, that pattern created the appearance of avoiding reporting requirements. Once you understand how the system interprets those patterns, avoiding that mistake becomes incredibly simple. So, if there's one practical exercise to take away from this conversation, it's this. Look at your financial activity through the lens of clarity. Ask yourself whether your major deposits, withdrawals, and transfers would make sense to someone reviewing the numbers without knowing your personal story. If the answer is yes, then you're already operating in a way that aligns with how modern financial oversight systems expect transactions to appear. And that brings us to the final and most reassuring part of this discussion. Because once you understand the rules and the logic behind them, protecting yourself isn't about constant worry or complicated strategies. It's about a few simple principles that keep your financial picture clean, transparent, and easy to understand. When you step back and look at everything we've discussed, a very clear picture begins to emerge. The rule at the center of this conversation hasn't suddenly appeared in 2026. The requirement for banks to report large cash transactions has existed for decades. What has changed is the environment around it. Financial systems are now faster, more connected, and much more capable of identifying patterns in the movement of money. That change has made certain misunderstandings far more visible than they used to be. But the reassuring truth is that the vast majority of retirees will never face problems related to these rules. Most people deposit their money normally, maintain reasonable records of major financial events, and file tax returns that accurately reflect their financial activity. When those pieces line up, the system works exactly as intended. Transactions are recorded, processed, and then fade quietly into the background of the financial system. The real purpose of understanding this issue is prevention. A simple misunderstanding about how bank reporting works could potentially lead someone to split deposits or arrange transactions in ways that unintentionally resemble structuring. And as we've seen, that pattern, not the money itself, is what can trigger scrutiny. Once you understand that, the solution becomes very straightforward. If you have more than $10,000 in legitimate cash to deposit, handle it in one clear transaction. Let the bank complete the normal reporting process. That report is routine and it simply documents the transaction in the financial system. There is nothing suspicious about it. In fact, allowing the report to be filed is usually the safest and most transparent way to handle the deposit. At the same time, make it a habit to keep records for major financial events in your life. If you sell a vehicle, keep the bill of sale. If you receive a large gift from family, keep a simple note documenting it. If you withdraw or deposit significant funds for a purchase or expense, maintain the receipts or contracts related to that transaction. These records don't need to be complicated. They simply provide context for the numbers that appear in your bank account. And when it comes time to file your taxes each year, make sure the financial story presented on your return matches what actually happened in your accounts. A qualified tax professional can help ensure everything is consistent and properly documented. When financial records align across bank statements, tax filings, and supporting documentation, automated systems have little reason to question anything. This approach represents a small but powerful shift in mindset. For many years, people believed the safest financial strategy was staying quiet and avoiding reporting requirements whenever possible. But in today's digital environment, transparency is actually the stronger form of protection. Clear records, straightforward deposits, and consistent reporting create a financial timeline that makes perfect sense when viewed from the outside. And that clarity leads to something every retiree deserves: peace of mind. You spent decades working, saving, and planning, so that retirement could be a time of stability rather than stress. The last thing anyone wants is a preventable penalty caused by a misunderstanding about how banking regulations work. The good news is that once you understand the rules, avoiding that situation becomes very simple. Deposit large amounts properly. Never split transactions to avoid reporting thresholds. Keep documentation for major financial events. Make sure your tax filings reflect your real financial activity. When those principles are in place, your financial story becomes easy to follow. And when your financial story is clear on paper, automated systems have nothing to question. That's where real financial confidence lives. Not in trying to stay invisible, but in knowing that everything about your finances is organized, transparent, and exactly the way it should be.